So the Indian rupee just did something big. It tumbled past a major psychological barrier against the US dollar. And you're probably asking, why is this happening and why so fast? What does it actually mean for India's economy? And where do we go from here? All right, in this explainer, we're going to break it all down. And this is the number that has everyone talking. The rupee hit an all-time low, touching 90.75 against the dollar. Now, this isn't just another small dip, It's a really significant milestone for the economy and for the markets. But what's really turning heads is the sheer speed of this fall. I mean, the slide from 85 to 90 rupees per dollar, that took just 349 days. That's the second fastest 5 rupee drop we've seen since the infamous taper tantrum back in 2013. So yeah, this really puts the intensity of this move into perspective. Okay, here's how we're going to tackle this. First, we'll look closer at the record fall itself. Then, we'll get into the 3 big reasons behind it. After that, we'll see who wins and who loses, ask if this is 2013 all over again, and finally, look at what the road ahead might hold for the rupee. Right, let's kick things off by putting this historic move into some context. How on earth did we get here so quickly? Well, this timeline tells the whole story. Just look at the acceleration here. To go from 65 to 70, that took over 1,800 days. The next few 5 rupee jumps, well, they still took hundreds and hundreds of days. We're talking years. But this latest one, from 85 to 90, under a year. That kind of speed is exactly what's grabbing all the headlines. So you have to wonder, what's causing all this pressure all of a sudden? Well, it's not just one thing. Analysts are pointing to what they call a trifecta of limbos, basically 3 major forces hitting all at the same time. So first up, there's a lot of uncertainty around a potential US-India trade deal, not to mention those steep 50% US tariffs. That makes businesses pretty nervous. Second, foreign investors are cashing out. After 2 really solid years of putting money in, they're now pulling billions out of Indian stocks. And third, you've got the RBI, India's central bank, which is kind of taking a step back. They're not jumping in to aggressively defend the rupee, letting it find its own level a bit more. And this chart, wow, it really hammers home that second point. Last year, in calendar year 24, we saw almost $20 billion flow into India from foreign investors. But this year so far, a complete U-turn. We're looking at an outflow of almost $18 billion. That is a huge swing, and it puts direct downward pressure on the rupee. Simple as that. Okay, let's switch gears and talk about the real-world impact. Because a weaker rupee isn't bad for everybody. It actually creates a very clear divide. You have some definite winners and some definite losers across the economy. Let's start with the IT sector. They are the textbook winners here. Think about it. They earn their money in strong US dollars, but most of their expenses, like employee salaries, are paid in rupees. So every time the dollar gets stronger, their profits look even better. But on the flip side, you have the airlines. They get hit hard. A huge chunk of their costs. We're talking 60 to 65% for things like leasing planes, buying fuel. It's all paid in dollars. So a weaker rupee just crushes their bottom line. And you see the same story play out elsewhere. Car makers and drug companies that export a lot, they love a weaker rupee because their earnings from abroad are suddenly worth more. But then you have oil and gas. India imports over 85% of its crude oil, and that bill has to be paid in dollars. So when the rupee falls, the cost of every single barrel of oil goes up, and that pain eventually gets passed on to all of us. Now, whenever the rupee is under this kind of pressure, a big question always comes up. Is this déjà vu? Are we seeing a repeat of the 2013 taper tantrum crisis, or is something different this time around? This table, right here, gives us a pretty clear answer. While the currency is struggling, the economy's fundamental health is just so much stronger today. I mean, just look at these numbers. GDP growth is up. The current account deficit is way down. Inflation is totally under control. And the big one, our foreign exchange reserves are more than double what they were back then. So the main takeaway here is pretty straightforward. This is not 2013. The economy has much stronger foundations and much bigger buffers to handle this kind of turbulence now. So, knowing that we're on much firmer ground, what are some of the things that could actually help calm things down and stabilize the rupee going forward? This number is a really, really big deal. India is sitting on a massive war chest of almost $700 billion in foreign exchange reserves. That gives the RBI an incredible amount of firepower to step into the market and prevent any wild, out-of-control swings if it needs to. And besides that huge forex buffer, there are a couple of other things to watch. A breakthrough on that US-India trade deal could bring investor money flooding back in. And, on a more technical level, a lot of economists argue the rupee is actually undervalued right now. Basically, once you account for inflation, our stuff is cheaper than our competitors, which could naturally push the rupee's value back up once all this uncertainty dies down. And all of this leaves us with one last, really interesting question to think about. We always see a falling currency as a bad thing, right? A sign of a weak economy. But could it also be a necessary tool? A way for a country's exports to stay competitive on the world stage? It's a complicated idea, and there's definitely no easy answer.